as everyone runs to, if a big bank failed, if it was a big one and this happened, a real big one, like a large regional bank, like, US Bank, which isn't a commercial bank, it's a big regional bank, they have to have a lot of uninsured deposits. If that happened, how fast would everyone watching this immediately try to get your money out and buy gold, buy a car, I don't care what you buy, get it out. So what got the banks in trouble last time, right? They loaded up on treasuries at 2%, and then they thought the rates could never go higher. And then the Fed jacks up rates by 500 basis points in a period of a year, right before the banks start to collapse. And now you have all these banks with toxic debt. So what did the Fed just do a week or two ago? They lowered rates by 50 basis points, right? Have you looked at the 10-year Treasury and the 30-year Treasury? Since they lowered rates by 50 basis points, guess what's up by almost exactly 50 basis points? The 10-year Treasury and the 30-year. It's the opposite of what they had intended, because the world says, no, no, no. Do you think we're going to be that dumb to hold duration bonds? A 10-year and a 30-year bond, and the 10-year is what the mortgages are based off of. You got mortgage rates up again to 7%. It's what the credit cards are based off. With average credit, you're at 24%. With bad credit, you're at 27% on average on the credit cards right now. So the 10-year, which is really the important one, has gone up as much as the rates on the short side of the curve have gone down. And that's the world's way of saying that we don't have an appetite for your debt with any duration at these rates. They have to be much higher. So I find it interesting that is affecting the banks because they have the 10-year Treasury. So again, it further starts to upset the apple cart in terms of the assets that these banks are holding. So as they continue to lower rates, is it going to be 50 basis points? That's what everyone thought. I think the smart money is saying more like 25 basis points now, but who knows? As they continue to lower rates on the front end, signaling inflation over austerity, you're going to have less and less appetite to hold the long end, which leads to monetization, which leads to the only one dumb enough to buy it is the Fed, which leads to hyperinflation, which leads to higher rates. They're trapped. They're trapped, and the world knows it. And the banks are at the center of all of this as they're loaded up with treasury debt. And then you see all the money leaving the banks, making it more unstable, going into the money markets. Well, we got that covered too, because we're going to gate them and they can't get out. So, there's a fine line between conspiracy and reality, Dunnigan, but I mean, this is too stupid to be stupid. The fact that you don't have this as breaking news everywhere, so people can get out of the way of this, is just unconscionable. And you're going to wrap up a lot of good people who never saw it coming, because you can't get out of the way of what you don't see coming. And that's why I even joke all the time, there are a lot of well-read people who just read the wrong stuff that are get hammered by this. And if it can happen in rural Oklahoma, don't think it ain't going to happen in one of these big cities that are loaded up on commercial real estate, that as commercial real estate starts to literally blow up, that will materially affect one of these banks, that they're going to have so much in unfunded or uninsured rather liabilities. It will bring down the system in a daisy chain as everyone runs to, if a big bank failed, if it was a big one and this happened, a real big one, like a large regional bank, like, US Bank, which isn't a commercial bank, it's a big regional bank, they have to have a lot of uninsured deposits. If that happened, how fast would everyone watching this immediately try to get your money out and buy gold, buy a car, I don't care what you buy, get it out. And that's why I've told people who want to own short-term treasuries, buy it directly through treasurydirect.gov. Get out of the way of the banks. If you have more than 250,000 in any one bank account, you're out of your mind. And this is proof positive of that. The Dodd-Frank Act, after the '08 crisis, addressed money market issues as everyone was yanking their money out of Lehman Brothers as they were failing, destabilizing the money markets. And let's remember that there's $7 trillion or just under in the money markets right now. It's not just all John Q. Public. It's not us. It's half of that money or more is institutional, pension funds and insurance companies and whatnot. And this is why they impose money market gating in the Dodd-Frank Act, because it will, if the buck were broken and the money market went upside down, it would blow up a lot of things, not just our pocketbooks, but pensions and insurance companies and all of these things that have over the last 2 years left the banking industry in search of yield. So at the same time, of course, they wrote in money market, or excuse me, bail-in legislation. And when it originally happened, and when you and I were talking about it at least 20 times, it was phrased in or kind of framed in the light, well, why would they write it into law if it wasn't ever going to happen? So when Silicon Valley Bank and Signature Bank failed, banks that held Oprah Winfrey's money and all the tech startups and hundreds of millions in uninsured deposits, the senator from Oklahoma was furious, and rightfully so, when he was questioning Janet Yellen in the House inquiry. Madam Secretary, you just bailed out these banks. What the heck? That's illegal. Yes, sir, it is. You're right, Senator, but it was an uber majority vote, as she says, from the FDIC, the FOMC, which is the Federal Reserve, myself, and the president. We deemed that they were too systemic and they needed to be bailed out. Of course, it won't come at the expense of the public. Yeah, right. The FDIC will handle it. And we've talked about the FDIC's lack of coverage, roughly 7 cents on the dollar, 148 billion backing 18 trillion. Well, that's not a good recipe. But anyways, the banks that have been bailed out subsequently, or that have failed, I should say, they haven't been bailed out, but they've been consolidated, as we've been told by Jerome Powell we could expect to see. Crumbs that they drop, little crumbs. There's a crumb. Yeah, they're gonna consolidate. That's a nice way of saying they're banks that are going to collapse, and other larger regional banks or JP Morgan, those kind of banks, will assume their position. And that's what's happened so far. So this has not really been noticed. Not only do most people have no idea, even sophisticated people have no idea what bail-in legislation is. They have no idea what money market gating is. When there have been banking problems, and let's remember, we added 14,000 clients in 45 days, the panic that was the banking problem, and yet it was brushed over, glossed over by the Fed coming in or the FDIC and bailing everyone out, right? Everyone was made whole. Of course, it's a bank. We've been putting money in our piggy bank since we were little kids. The bank is safe. Putting it into an investment isn't safe, but a bank is safe, right? Well, the Dodd-Frank says you are an unsecured general creditor, i.e. last to be paid. So let's talk about the First National Bank of Lindsay, Oklahoma. And I'm going to read a couple things to you so that people really understand it. For those who haven't heard this or haven't heard me talk about it last night or earlier today, Friday, the First National Bank of Lindsay was closed by the Office of the Comptroller of Currency, with the Federal Deposit Insurance Company, the FDIC, appointed as receiver. The OCC acted after identifying false and deceptive bank records and other information suggesting fraud that revealed deception of the bank's capital. The OCC also found that the bank was in an unsafe and unsound condition to transact business, and that the bank's assets were less than its obligations to its creditors and others. Now, let's just highlight that. I want people to remember what I just said there, that their assets were less than its obligations to its creditors and others. So highlight that and remember that for a moment. The OCC is referring the matter to the U.S. Department of Justice, which has a wide variety of tools to hold individuals accountable for criminal acts and focuses on victims in all of its matters. Okay, that's good. To protect depositors, the FDIC has entered into a purchase and assumption agreement with the First Bank and Trust Company based in Duncan, Oklahoma, which will assume the insured deposits of the failed bank. Now, this bank has 7 million. It's a small bank, only 7 million in uninsured deposits, right? Anything over the FDIC limit, 7 million. Not a big bank like Silicon, which had hundreds of millions. This has 7 million. So the sole office of the First National Bank of Lindsay will reopen as a branch of First Bank and Trust Company during its normal business hours on Monday, October 21st, just a couple of days ago. All depositors of the closed bank will automatically become depositors of First Bank and Trust Company, and their insured deposits will continue to be covered by the FDIC. Okay, that's good. And customers are not required to change their banking relationship to main deposit insurance coverage. All of this is good so far until for uninsured depositors, $7 million in uninsured deposits in this small town in Oklahoma. Ironic that it was the senator from Oklahoma that was grilling Janet Yellen. The FDIC has announced it will make 50% of those funds available. That's $3.5 million of the $7 million to depositors starting Monday, October 21st. Now, here's the kicker and what you mentioned in the onset. with the possibility of increasing that amount as assets from the failed bank are sold. Now remember, the assets are less than the liabilities. So when they sell whatever assets they are, now I was doing an interview with David Morgan today and talking about this. And he said, Andy, let me stop you. He says, I've been studying this stuff for a long time, and you're right. And what happens is that extra money, they're not going to get it if they are going to get it at all. By the way, it's 4 years they have, up to 4 years to receive this money, as you and I have talked about before. But he said, it's my understanding that these people who have been affected will receive shares of the new First Bank of Duncan or whatever it is here. And so they're not going to get cash back. They'll get shares of a new bank. This is an eye-opening experience. And in essence, you have $1 million in the bank. You're going to buy a new home. You're building a new home. You're under contract. It fails. You get your 250. Okay. And in this case, because it's a small bank and there's only 7 million uninsured, of that million, you're getting 50% back right away. So that 750,000 is uninsured. You're going to get 375 plus your 250 is 6.25. That other 375, bye-bye. You ain't getting it. And you might get some shares, maybe possibly, as the thing says, over the next 4 years. Now, my question to you is, where is journalistic integrity? Where are the reporters? Where's 60 Minutes? Where's 2020? Where is the outcry? Where is this? Why is this not on the front page of anything that is news, or on the opening of any news story? Why isn't it all over CNN and Fox News and Bloomberg? It's a joke. And it's a trial balloon. Look, this happened. It was public information. Didn't you see it happened in Lindsay? So all that it will take is for a bank to be bailed in, a big bank, really bailed in, and maybe they don't even get the 50%, or a money market gating environment to trigger craziness. I would like to add one last piece to this before I take any questions or comments from you. When Silicon and Signature failed, remember they issued the BTFP, the Bank Term Funding Program, and that was a 1-year loan with onerous terms. They had to post collateral mark to market at about 5% interest. And if you look at what the liquidity in the banking system looked like right before they started that, they put that money in because things were collapsing as liquidity was drying up. Bill Holter always talks about this environment being one of a potential liquidity crisis. Well, it looks exactly like it did in 2019, right before the repo market blew up, and exactly like what it looked like in 2020 when the stock market blew up. And that's exactly what it looked like when those banks failed, a liquidity crisis. So they injected all this money. Now, guess what day the BTFP is set to be drained to zero? All of the loans must be paid back. You have a guess what day that is?
I think it's the day before the election.
It'd be the day after the election.
The day after the election.
And so you want to talk about a rug pull. If they really wanted to pull the rug and set Trump up for this kind of, if he wins or whoever wins, maybe if it's Trump, maybe they like it. Maybe they extend it, or maybe not. Maybe in the midst of craziness, in terms of half the country being beside themselves, and what we've seen over the last few years is any indication of what we could see. It's frightening. Add into it people losing their money. And as Gerald Celente often says, when people lose everything, they lose it. So, you got 5 million in a bank and all you get back is 250,000. Are you going to lose it? I think a lot of people would. I think people need to be made aware of this. And the fact that this isn't front and center, then again, it is absolutely mystifying to me. So anyways, that's what I wanted to start this conversation with, because this is a bail-in. I mean, I don't know what else it is for them to say you might or possibly get that other half back once they liquidate the bank. We have up to 4 years, and by the way, those assets are already less than the liabilities. So I don't know. It's a scary thought experiment.